Hey, what's up, my friend? So in today's video, I want to share with you this weird pattern that has been happening in the US stock market. And it's something that not many traders are aware of. Okay, so if you can exploit this pattern, right, stock trading becomes easier and more profitable. So let's get to it. So have a look at this chart over here. This is the chart of the S&P 500 over the last 5 years. Take about 5 seconds, right? And tell me, what do you see? What's the pattern that stands out? 1, 2, 3, 4, 5. Okay, don't tell me the answer just yet. Have a look at this chart over here. This is the chart of the S&P 500 over the last 10 years. What is the one thing that stands out? What is the pattern that you see? Again, just take about 5 seconds. 1, 2, 3, 4, 5. Again, don't tell me the answer just yet. One last chart here for you. This is the chart of the S&P 500 over the last 30 years. 1, 2, 3, 4, 5. Okay, so now, what is the recurring common pattern that you've seen, right? After showing you the charts of the S&P 500 over the last 5 years, the last 10 years, the last 30 years. The answer is this, right? Pattern number 1. The stock market, the US stock market in particular, is in a long-term uptrend. So this means that it's going to be easier to make money in the stock markets, right, by going long stocks rather than shorting it. So this is the first pattern that I want to share with you. Now, moving on. The stock market is open 6.5 hours each day. I mean, based in Singapore, it opens about 9:30 p.m. every day and closes at 4 a.m. So in the US, it probably opens at 9:30 a.m., close at 4 p.m. Okay, just the inverse, 12 hours in front. So now, let me ask you, if the stock market every day it opens at 9:30 a.m., assuming that you are based in US, and every time you buy when the stock market opens, and you sell when the stock market close. So you buy at the opening price and you sell at the closing price. What will your equity curve look like? What will your trading account results look like? Well, I've run a backtest and let me share with you the results. Okay, so you can see over here, you buy at the open and you sell at the close, right? This is what your equity curve will look like this. So you can see over here, I've run this backtest from 1993, right? From here, 1993 till currently, I think this was about 2023. You can see that you start off with $1 million, right? $1 million. After a good close to 30 years, your account is actually in the red, right? You left $831,000. So you have actually lost money buying at the open and selling at the close, right? If you do this every single day for 30 years, right? And by the way, to do this backtest, I run it on the SPY. Basically, is the ETF, right, for the S&P 500. Now that you know that you buy at the open and you sell at the close, it's a losing strategy. Now, what if you buy at the close and you sell at the open? Would the results change much? Let's find out. So I run the backtest again, same thing, right? On the SPY, the S&P 500 ETF, I buy at the close and I sell it at the open. I don't even take into account commissions because we just want to see if there's any pattern that stands out. And have a look at this. Ta-da! You can see over here, look at this equity curve. You started off with $1 million, right? After 30 years, it's about $9 million. Okay, you can see that this time around the equity curve is actually sloping higher towards the right side. So what does this tell you? This is very significant. This is very important. Okay, pay attention. Pattern number 2 is this. There's an overnight bias towards the upside. And by the way, I learned this concept, right, from this website called quantifiedstrategies.com, right? So they actually shared this findings, and this is where actually I learned it from. I first came across, right? So there's an overnight bias, right, towards the upside. So what does this mean? This means, right, that if you trade stocks, if you buy stocks, it's going to be easier to make money holding stocks for a few days, a few weeks, or even a few months because of this overnight bias. Does it make sense? Now, using these two concepts which I've just shared with you in mind, right, let me share with you a stock trading strategy, right, that you can use to profit in the stock markets, okay? So now, this strategy, I don't want to, spoon feed you the exact parameters, entries, exits, and stuff like that, because I want you to think on your own. So I'll give you the strategy, but it's going to be based on broad-based concepts. And if you can understand the concepts, you can simply tweak the strategy to your needs, right? So let me give you the rules of this trading strategy that will serve as a foundation, right, for your own strategy, right, if you want to make certain tweaks to it. First thing first, number 1. The stock, right, must be part of the Russell 1000 index. And this reason is very simple. we want to be trading stocks that has high liquidity, right? Not those stocks with very small cap that is very can be easily pump and dump, right? So we don't want to get involved with those stocks because those are a lot more volatile, right? And it's not part of our strategy. We only want to focus on stocks that are big caps, right? So pretty much the largest 1,000 stocks in the US stock market. Next, the stock is above the 200-day moving average. Why is that? Simple. We want to make sure that the stock is in an uptrend. It's trending up higher, and the 200-day moving average can help us with it. So the stock must be above the 200-day moving average. And again, some of you might be wondering, Rayner, so do I use the simple moving average, the weighted moving average, the exponential? Doesn't matter. The concept is what matters, okay? The concept is what matters. You want to use the simple, exponential, weighted. It's really not important, okay? Next, the 200-day rate of change is higher than the S&P 500. So some of you might not be familiar with this. So let me explain what is the significance of this. So the 200-day rate of change simply measures, right, the stock price relative to where it was 200 days ago. So basically, you're measuring the change in price from now and 200 days ago. So if the percentage change in price is higher, that means the ROC value will be higher. So let's say the ROC over the last 200 days is 50%. This means that the stock price has increased 50% over the last 200 days. So when we measure the ROC over the last 200 days, which is about close to a year, okay, we want it to be higher than the S&P 500 because this tells us that in terms of relative strength, this stock is actually stronger than the stock market index. And stocks that are stronger than the stock market index, for example, this stock A goes up 50% over the last 200 days, and S&P 500 goes up, let's say, 10% over the last 200 days. So you compare both of them, stock A is stronger in terms of relative strength compared to the S&P 500. So this means, right, this stock is likely to continue higher, right, relative to the S&P 500. So this is why we have this filter over here. Basically, want to identify the strong stocks from the weak stocks. Next one, okay, breakout after a consolidation. So this is simply a entry trigger to get us into the trade. So let me walk you through, right, an example, right, of how this will look like on the chart. So we pretty much want to find stocks that are in an uptrend like this. Okay, so if you overlay with the 200-day moving average, the stock will be in an uptrend. Then we are looking for the consolidation, something like this. Okay, so ideally, I like to see a tight consolidation near the highs like this. This is what we call a breakout with a build up. Okay, something like this. Okay, this mouse tool is acting a little funky, like how my kids are a little funky, right, whenever they don't have their nap. Okay, so once we have this consolidation over here, then when the stock breaks out, okay, we want to look to buy. Okay, so this is an example of the trading setup that we are looking for. And of course, prior to the breakout, we are going to look at the 200-day rate of change, making sure that it's higher than the S&P 500. We don't want to buy weak stocks. We want to buy strong stocks. So make sure that the 200-day ROC, right, is higher than the S&P 500. So let me walk you through a few examples, right, so you can see this in action. Okay, now the first example we have over here is Nvidia. Okay, so you can see this stock, right? Let me just pull out some indicators so you can see what I mean, right? Let's go with moving average first to define the trend. Okay, so again, with moving average, exponential, reburn, simple, I'll just go with simple. Okay, and I'll just go with the 200-day moving average as I've shared with you earlier. I like to be a little bit irritating. I like to go with black because that's my standard definition of the 200-day moving average. I like to highlight it in black. So you can see over here, the stock price right now, it's above the 200-day moving average. See, the price is here, 200-day MA is here. So you can see clearly it's in an uptrend, a series of higher highs and higher lows, uptrend. Good. Next thing, we want to make sure that this stock compared to the S&P 500, right, in terms of relative strength, it is stronger. How can we do that? So look for the ROC indicator, ROC, rate of change, pull this one out. Again, I like to compare it over the last 200 days. So input, just change it to 200. Okay, click OK. So you know that this stock, right, Nvidia, at this point is 87.4. How do you interpret this? This means that Nvidia, over the last 200 days, yes, went up 87.4%. Now, compare this to the S&P 500. Let's see the difference. So we can use either SPY or SPX. Right? Let's go with SPY. This is the ETF. The SPY, in this case, is up 17.3%. Actually, it's pretty impressive, right? But not as impressive as Nvidia, right? So S&P 500 up 17.3%, whereas Nvidia at this point in time is up 80+%. So clearly, in terms of relative strength, this stock is stronger than the S&P 500. Now, what about the entry trigger? So remember, we can share with you a potential breakout trading setup. So you can see over here, in terms of the chart pattern, for those of you who trade chart patterns, you know that there's something brewing over here. Look at this area of resistance, okay? Price has come up into this area of resistance a number of times, right? We went up here, pull back, then finally go up here a second time, made a pullback, here back a third time. And also, for those of you who are familiar with chart patterns, we have a series of higher lows coming into resistance. So this is a sign of strength. So if I were to see this, and knowing what I just shared with you earlier, you know, we want to be long stocks because it's easier to make money compared to shorting. We want to hold trades for a few days or even a few weeks, right? Because we have this overnight bias. Now we can look for a specific entry trigger to go long. So for example, let's say if we have a bullish close above resistance, that would be a valid entry trigger to go long. Stop loss wise, again, depending on how aggressive or conservative you want to be, you can put it a distance below these lows, or even you can reference this swing low, right, and put it a distance below it. So you have a couple of options depending on how you want to manage your trades. So in this case, let's see what happens. Okay, it went up, boom. Why is that? Because I cherry picked this chart just to prove this illustration, so it's easier for you to understand. But bear in mind, right, when you trade this in live markets, there are times where it breaks out and then suddenly reverse and hit your stop loss. It happens so often, right? So be prepared for that, right? Don't want to, you know, mislead you to think that, you know, this is the holy grail or whatsoever. So in this case, you can see the stock, right, did actually work out in our favor, okay? And now, how can you manage this trade? So many ways to go about it. For traders who wants to capture a swing, right, one concept I can share with you is what we call the price projection technique, right? So what this group of traders will do is they will measure the highs from here to these lows over here, okay? And then they project, right, this distance over here, this distance, they just copy and paste, and then they project it up higher. Then over here will be their take profit level. So that's one option you can go with, right? I think there's a tool for it, Fibonacci extension or something along those lines. Let me see if I can find it. Trend-based Fib extension. Okay, let me just do this. Up to the highs and down to these lows over here, the lows of the range. Okay, so if you look at 2.0, right, this is where you would take your profit over here, right, at this 2.0 level, somewhere about here. So this is for you to capture this swing, right, one move in the market. For traders who don't want to capture a swing, if you want to just ride a trend, right, one simple technique can go with, let's say, a moving average, right, the 20-period moving average, right, if you want to ride a short-term trend. If you want to ride a longer-term trend, you can use like a 100-day or even a 200-day moving average. So in this case, let's say we go with a 20-period moving average. So how it's going to work is that if the stock price closes below the 20-period, the 20-day moving average, you would then exit the trade. So in this case, you can see over here, I believe we have a close over here, and this is where you would probably exit the trade. Yeah? Okay, now another example that I want to share with you is Microsoft. So I'll go a little bit faster as well as share with you a few tips that I didn't manage to cover earlier. So Microsoft, you can see it's in an uptrend. It's definitely above the 200-day moving average if you plot it on the chart. So the next thing that we want to do is to check, right, compared to the S&P 500, the SPY, is it stronger or weaker? So we pull out the rate of change, right? So I have it over here on this chart. The rate of change right now is 35.84. So it's 200 period. This tells you that over the last 200 days, Microsoft went up 35.84%. Now, what about the S&P 500? Let's have a look at the SPY, which is the ETF for it, right? Gonna spy on you. Okay, the S&P 500 also in an uptrend, not surprisingly, and the ROC, the value is 16.5. So this tells you that the S&P 500 over the last 200 days has went up 16.5%. So compared to Microsoft, Microsoft is stronger than the index itself, right? So that's a good thing, right? We want to be buying strong stocks, right? Not weak stocks. So if you identify stocks that are in a range or in a downtrend, their ROC values will likely, you know, be negative, right, compared to the stock market. So those are weak stocks that you want to avoid. So as much as possible, buy strong stocks, stocks that have a rate of change value that is higher than the index, higher than the stock market. So back to Microsoft. So if you look at Microsoft, okay, so now you can see that the price action of this stock is in an uptrend. And what I really like about this is that notice this consolidation. It's pretty darn tight, right? Notice the tightness of this range is getting tighter and tighter. It's just between $142 and $132. And if you notice, right, within this range, we have a series of higher lows, higher lows, higher lows coming into resistance again. So really, whenever you trade breakouts, right, one of the so-called cheat code, right, if you want to call it, is that look for a series of higher lows into resistance. That is a sign of strength. That is a tip, right, that the market is trying to signal to you that it's more likely to break out higher than lower. So ascending triangle, higher lows into resistance is a sign of strength. Market is more likely than not to break out higher. So again, the entry trigger is simple stuff, right? A break and close above resistance, that would be a valid entry trigger. boom, to go long. So in this case, right, with a gap up higher, and it closed marginally lower for the day. It didn't look quite as bullish as Nvidia as we've seen earlier, but still, this to me is still a legitimate breakout. In fact, whenever there's a gap above resistance, like the gap above higher, that to me is a sign of strength, because it shows you that there is demand, strong buying pressure. That's why there's a gap up higher above resistance. So again, I have no qualms, buying a gap up higher into resistance. I wouldn't have the thought process of thinking, oh man, this gap is going to get filled, come down lower, get filled, right? It may not, right? Especially in strong trending markets, it might just gap up and then just continue up higher. So if you wait for the pullback, the retracement to come, it might never come. Okay, so again, entry trigger, you can go long on the next candle open. Again, stop loss, depending how aggressive or conservative you want to be, you can set it a distance below this lows, right? Or a distance below this area of resistance, right? So somewhere about 140, below 140, somewhere about here. Personally, for me, I like to give it usually a little bit more buffer. So my stop loss will be from this open down to this level, right? This would be the distance of my stop loss, which is about, in this case, about $5. Okay, so in this case, you can see that the chart of Microsoft, right? This one, yep, I cherry picked this chart as well, right? And it moves in our favor. So now, one thing to share is that there are numerous ways that you can manage this trade. So earlier we talked about using the 20 period moving average to trail your stop loss. That's one option. I shared with you how you can capture a swing. If you want to use the 50 period moving average, right, that is fine as well. In this case, you probably will give back a larger chunk of the profits. So one thing to bear in mind is that if you use a smaller moving average, a tighter moving average, like the 10 or 20 day moving average, you will usually capture a shorter term trend in the market. Okay, so any shallow pullback, you'll likely get stopped out. Whereas if you use a longer term moving average, like the 50-day moving average, you will capture a longer term trend, but at the same time, you risk giving back even a larger chunk of your open profit. So there's kind of like pros and cons to it. Okay, and another thing to add is that another way you can trail a stop loss is using the price action of the market. So as long as the market makes a series of higher highs and higher lows, right? Higher lows, higher lows, higher lows, higher lows, right? It's probably higher lows, right? So over here, this lows was invalidated when the price breaks and close below it. You can manually exit this trade. So basically, you're looking for a series of higher highs and higher lows. As long as the previous low holds, you hold the trade, right? If the price breaks and close below the previous swing low, like in this case, you exit the trade because it breaks and close below the previous low. So there's another trailing stop loss technique that you can use. Okay, now let's do a quick recap, shall we? Right, so I just shared with you a simple but effective breakout trading strategy to trade the stock markets. I didn't give you specific parameters like when exactly to buy, when to sell, but I shared with you broad-based concepts that's based on stats, based on things that has been happening in the US stock market for the last 10, 20, 30 years. So use those concepts to your advantage, right? And of course, you, instead of trading breakouts, you can also trade pullbacks. There are ways to trade pullbacks, right, that I didn't manage to cover in this video. But if you want to learn how to trade pullbacks in the stock market in a simple and effective manner, then you can join me at this upcoming webinar where I'll share with you a simple stock trading system that has generated 3,225% over the last 22 years. Okay, so the link is over here, tradingwithrayner.com/STS. You can sign up, it's free. I'll put the link below this video as well for your convenience, right? And I'll share with you, this simple trading system, right? The next one is in August, but again, if you missed it, you can join me in the next one sometime in probably October, right? Or whatever date that is posted over here, yeah? So I'll put the link below over here, okay? And just a quick recap, right? Number one, the stock market, remember, it's in a long-term uptrend, in particular the US stock market, not every stock market around the world, but in particular the US stock market. Number two, there's an overnight bias towards the upside. This means, right, that as much as possible, you want to be holding stocks for at least a few days or even a few weeks. And if, the trend really runs, why not a few months, yeah? So the first one is a reminder to, as much as possible, right, you want to be buying stocks and not shorting it. The path of least resistance is towards the long side. You can short, but make sure you know what you're doing, or you're at least a certain level of proficiency before you want to consider shorting stocks, yeah? And with that said, yeah, that's pretty much it, right? So with that said, wish you all good luck, good trading. If you want to join me at the free upcoming webinar, the link is below. Take care, and I will talk to you soon.